Index annuities versus the stock market. Let's get right into it. Why this comparison comes up a lot with our clients, especially pre-retirees and retirees, is because both are tied to the market performance, right? Both are want your money to grow. And as investors, that's the main point is let's invest money and let's have our money grow. But the question always comes up is how do I want it to grow? Do I want to do the stock market, index annuity, CD account? Risk feels very different though, because they are two different products. Now, remember, you could always do both, right? A lot of times people think it's one or the other. I work with many clients where, hey, we keep money in the stock market and we also do index annuity, but understand they're both tied to the performance of the stock market. But how exactly does the stock market work, right? Let's go over the basics. Your money is directly exposed to the market gains and the losses. So if you're invested in, let's say, your traditional IRA, 401k, 403b, or you have a brokerage individual account and you're investing in a stock market, maybe it's individual stocks, index funds, ETFs, you will participate in the gains, which is wonderful. Also understanding that you will participate in the losses. Okay. But another benefit of the stock market is, yeah, you do get a limited upside potential, right? We hear stories all the time where investors buy a stock that ends up going 100%, 200%. If you look at Nvidia, Netflix, Tesla, like these companies have gone up very well with unlimited upside. But understand there is volatility, right? Yes, the US stock market has done exceptionally well. It's created a lot of wealth for Americans, but there is a lot of volatility, a lot of unknowns. It all depends on the timing of your life, the outcomes, what you're looking for. But the key thing with the stock market directly is you do participate in the gains and the losses. So this is where index annuity could come in, where it could be a portion of your overall portfolio. As long as it makes sense for you, they're definitely not for everybody. But your growth is linked to a index. Your money is not directly invested in the stock market. That's why when the stock market goes negative, you do not lose money in index annuity. And because your money is never directly in the stock market. But understand the upside potential. Okay. Depending on the company that we do business with, a lot of times they put a cap on your earnings. That cap could be 10%, 12%, 7%. Sometimes they do a participation rate, meaning you only get a percent of the total return. So it all depends on how you structure it, what company you go with. But the main point of index annuity is to remove the risk from your portfolio, understanding you're not going to get the 15, 20, 25% stock market gains. But more importantly, you're not going to lose the 10, 15, 20% like you can in the traditional stock market. So how to think about the choice? What's the right decision? Once again, everyone is different. We customize and tailor a plan based on your goals and what you're looking for. But the stock market really favors the long time horizons. Why is that? We're not traders. This isn't a hedge fund. But if you look at the history of the stock market over the course of 10, 15, 20 years, it's done pretty well for your investments. Yes, there will be moments where you're negative, but if you hold tight, wait, the markets will come back up. But index annuities really favor predictability and protection. This is why they're really structured for pre-retirees and retirees because it comes down to time, right? If you're currently retired right now and the stock market goes negative, well, we might not have time to wait for the stock market to come back up, especially if you're starting to withdraw from your investments. You might get hit with that double whammy of a negative stock market and a withdrawal. Then your account could be down a higher percentage than what you're really anticipating. So this is where index annuities come in, is protecting a portion of your assets. So if the market does decide to go down, you have that predictability. Risk tolerance as well, right? I work with clients where they see the value behind index annuities, but they're willing to take on more risk, and that's okay. It's their money. But I've also worked with many clients that say, you know what? I understand that I need to minimize our risk. I'm in retirement. I'm getting closer to retirement. If I could protect a portion of my assets, and that portion is subjective based on suitability and what they're looking to do, it's all about timing and what that person wants to do with their retirement. So this is where we come in once again, is customizing the plan based on what you're looking for, not the generalities of the advantages and limitations of the different strategies that are out there. Okay, so the big takeaway, look, stocks prioritize growth, especially if you're doing S&P 500, small cap, micro cap, Russell 2000. Look, people do the stock market because they want their money to grow, and there's nothing wrong with that, okay? But index annuities, they focus on playing defense, on protection, and at the same time, you can grow your account, but you're not going to grow it as aggressive as being in the stock market directly. And once again, many of my clients, we use both. There's nothing wrong with that, right? That's what's great about money. You could have several accounts, different strategies, protect some, grow some, take on more risk, minimize risk, push the risk on the investment company. Everyone is different. But if you do have additional questions, this is why I put together my free educational guide on index annuities. I called it Smart Growth and Safe Returns. Request it below. The link is in the description, but I appreciate you listening today. Thanks for watching. If you found this helpful, hit that subscribe button today. And if you're ready to take the next steps, feel free to schedule a discovery meeting with Core Financial Partners. Until next time, take care and keep building smart.